Welcome! Today we'll be looking at 5 stocks which are trading near their 52-week lows in March. And honestly, I'm surprised that most of these companies are trading at these levels. So let's start with the best one, which is none other than Microsoft. Ticker symbol MSFT. It's in the technology industry. This company needs no introduction. It is one of the world's most valuable companies, and the thing is that in the past year, it's actually down by over 2%. And this is because in 2024 it actually rose a lot. It rose by over 40%, and the stock was deemed as trading at a very hefty valuation. Having said that, this company's fundamentals are incredible. They pay a very solid dividend and they're currently yielding a 0.76% dividend yield, which for such a fast growth company as Microsoft, it's very nice to see such a high dividend yield. And it is a dividend yield which they are actually managing to grow at a very fast speed, as their 3-year dividend CAGR is around 10%. And as we can see from their valuation, in the past year their stock may have stayed stagnant, but their fundamentals have kept improving. Since their stock is currently trading at the same price where it was trading last year, but their revenues and their net income has increased substantially, we can see that it is currently cheaper than in any of the last quarters. Currently sitting at a price to earnings ratio of just above 30 times, and honestly, at these levels, I will be conducting deeper analysis on Microsoft because I think this could be an opportunity to buy the company. When we look at these companies' fundamentals, we start to remember why this company is one of the most valuable in the world. Their revenue, their gross profit, and their net income have increased every single quarter at a very predictable pace and at a rate that, when we take into account that this is a company that is worth well over $3 trillion, is incredibly impressive. Additionally, they've been able to do this while keeping their margins extremely consistent, with their net margin being above 30% for the past couple years. The one thing that may surprise you here is their cash flow evolution, which has actually been decreasing quarter after quarter, but this has a solid explanation. If you look at the free cash flow evolution of other companies such as Google, Amazon, or even Apple, these have also been following a similar tendency, and this is because these companies are starting to battle it out at the cloud segment. They're starting to incur in higher capital expenditures, which are decreasing their free cash flows at a very high pace. But this, in theory, is because they expect this segment to be extremely profitable and grow at an extremely fast pace for the following years, which means that all of the free cash flow that they're sacrificing at the current moment, they expect to gain with a lot of interest in the future. And finally, when we look at their balance sheet, this company is a monster. Their total assets are way above their total liabilities, and honestly, this company has no reason to worry about debt anytime soon. Now, stock number 2 is Intuit, which is in the software industry. And this company as well had been growing at a very fast pace, and the main reason why this company is actually being beaten down is because of the high expectations that this company had, because it was trading at a very hefty valuation. As we can see, this company was trading at a PE ratio of above 60 times, which, you know, Wall Street, the moment you're trading at a very hefty price to earnings ratio, and you have a quarter which is not perfect, your stock will get punished, which is what is happening currently to Intuit. However, as well, this could be an opportunity to pull the trigger into this great company. And this is another example of a fast-growing company which is starting to pay a very attractive dividend, with a dividend yield of 0.68%, but a 3-year dividend CAGR of above 15%, which is incredible. Now, there is one thing with this company, and is its cyclicality. From what I have seen, all of their quarters, except for quarter 3, have very low revenues. However, in quarter 3 of every single year, it looks like it's when all their licenses, which mainly consist of annual recurring licenses, are renewed and when the income is recognized. This is why the graph looks a bit like this. And this also carries on when we look at the cash flow evolution, where quarter 3 of 2024 is the clear winner out of all the quarters, and when we look at their margins, it's when they have a net margin of above 30%, whereas for the rest of the year they have a net margin between 0 and 10%. This makes it extremely difficult to analyze their monthly growth, because the only significant quarter, let's call it like that, it's quarter 3 2024. However, if we look at an annual growth rate, this company has been killing it during the past years. And additionally, this company also has an amazing balance sheet, with their total assets sitting at way above their total liabilities, and despite their total liabilities having been growing over the past couple of quarters, their total assets have been growing at a very similar pace, which has kept their current ratio in line. Now, before we move on to company number 3, remember that all these charts come from TradingView, and down below you can find a link where if you want to access any of the paid memberships that TradingView offers, you can get a discount. But company number 3 is none other than Nu Holdings, ticker symbol NU. Now, this company is up 4% over the past year, so it's technically not trading at their 52-week lows. However, if we compare to the fact that this company was trading near $16 a couple of months back, looks like this company has fallen substantially due to their latest earnings. Now, this company does not pay a dividend yet, it is a very fast grower, and it is in the financial industry. The majority of its operations are based in South America, and as we can see, a couple of years back, it was one of those companies which had incredibly high expectations, which is why the price to earnings ratio seems so small despite being a 37 price to earnings ratio. I believe that in the first quarters of 2023, this company was trading at over 1,000 price to earnings ratio. However, as we can see, this company has actually been trading at a fairer valuation every single quarter, because their stock is always bouncing back to the $11 price point, but their fundamentals keep improving. This company has that specific quality which we love to see, which is the predictability and consistency of their financials. And this can be seen by their total revenues, their gross profit, and their net income growing at a very consistent pace every single quarter. The thing is that even if this company is handling very fast growth, they're able to do this while keeping their margins constant. As we can see, both their gross margin and their net margin have not moved much, and their net margin, which is the important one, is sitting above 20%. On the other hand, when we look at the cash flow evolution, Q3 and Q4 2024 are not available in TradingView. However, from what we could see, they're not extremely consistent yet. Yes, these cash flows are growing, but in these type of companies, which don't have a lot of capex, we prioritize seeing a lot of consistent cash flow being generated in order for them to use either in expanding their business further or in buying back shares. And when we look at their balance sheet, we can see that their total assets are above their total liabilities, which makes this company to be a relatively safe investment. Now, stock number 4 is none other than Advanced Micro Devices, commonly known as AMD, which is of course in the semiconductor industry. Now, this company had a lot of hype in the past couple of quarters, but in the last year, it's gone from trading at around $210 to $105. Down 40% in the past year and over 50% from those highs. This company, of course, does not pay a dividend because semiconductor companies are extremely cyclical and it would be tough to maintain a dividend for these kind of companies. However, when we look at their valuation ratios, we can see that these have fallen quarter after quarter. But it makes sense. I mean, in Q1 2024, AMD was trading at a price to earnings ratio of over 210 times. And even now, when it has dipped by so much, it's still trading at a very hefty valuation. And yes, I understand that this company's revenues are growing substantially, and that additionally they're growing their gross profit and their net income at an even faster pace because they're also managing to improve their margins. However, as we can see, in the latest quarter, their net margin actually suffered and it contracted back to Q2 2024 levels. I'd like to point something out from this company, and it's their incredibly consistent cash flow evolution. In Q1, Q2, and Q3 of 2024, they were growing their free cash flow generation at a very sustainable, consistent, and predictable pace until in Q4 2024, this cash flow generation actually exploded, and it came in at over double what they had been generating in the previous quarters. We can see that this company is incredible as it almost has no liability. Its total assets are way above their total liabilities, they won't have to worry about debt anytime soon, but if I would like anything from this company is to get a bit more certainty over their future and to gain a bit more predictability. And last but not least, we have the Trade Desk, ticker symbol TTD. And this company had been a big winner of this year up until their latest earnings release, where their stock fell over 30%, and it actually is down over 10% for the full year at the current moment. Now, this company offers software and it had been growing at a very fast pace for the past couple of years, so instead of paying dividends, it was actually reinvesting all of their free cash flow generation back into the business. And as we can see, their valuation actually commanded a very fast pace, as they were trading at a price to earnings ratio of over 200 times for the past 3 quarters. That is not the case anymore. But don't get me wrong, they're still trading at a pretty hefty valuation. And when you see this, you may be shocked. The fourth quarter of 2024 was actually their best quarter, generating record revenues, record gross profit, and record net incomes with a net margin that they had never seen before, rising over 23%. This company has been doing a great job, but then what commanded that over 30% price decline in the stock? most of it actually came in due to their expectations and their guidance for the following quarters, which actually projected that their growth was going to be a lot slower than what they had said initially. This, of course, could present a buying opportunities for investors which don't care too much about their top line growth and care more about their bottom line growth. Now, when we see their cash flow evolution, we can see that generally it is very predictable and it is generally trading at around the same value. However, in some of these quarters, they decide to invest a lot of this into capital expenditures, which decreases this free cash flow generation. However, since this is a company which offers software, this is not very common. And finally, when we look at their balance sheet, we can see that this company is also a secure investment, as they have over twice the total assets than their total liabilities, and their total assets have been expanding at a faster pace than their total liabilities. So anyways, thank you so much for watching. As always, this has been the Cashflow Compounder. Join the free Patreon for extra content, and I'll see you in the next one.